Revenues are an element of accounting that are inflows of economic benefits or savings and outflows of economic benefits. And they have to do one of two things. Either assets have to go up overall or liabilities need to decrease overall. And the ultimate effect of a revenue is that it must increase owner's equity. So, sort of representing that as a diagram, a revenue is something that's going to make owner's equity go up, and there's two ways it can happen. Either assets can increase, and that'll be called an inflow of economic benefits, or liabilities can decrease, and that'll be a savings in outflows of economic benefits. So, for example, a small business made a cash sale of $5,000. Our assets will go up $5,000. We don't have another asset going up. We're not getting anything else besides the cash. We don't have a liability going up or down. So therefore, the only other effect here is that owner's equity or capital is going to go up $5,000, therefore meeting our definition. We've got an inflow, cash, we've got an increase in assets, and lastly an increase overall in owner's equity. Changing the example slightly, the same business made a credit sale of $7,000. Again, we've got assets going up, just a different asset. Instead of cash, we now have debtors increasing. No other assets going up or down, no liabilities going up or down, so the other effect will be that this is going to increase our capital $7,000. So the same effect, just a different asset going up in this case. Looking at a big business like Harvey Norman, their most common revenues are sales of products. That's predominantly the one that we'll deal with in Unit 3 accounting. Franchise fees, so like McDonald's, Harvey Norman franchises their name, and they also rent out their stores to those franchisees. And interest on their investments. So we'll definitely deal with interest and sales of products as well as one or two other revenues during the year. Just looking at three examples, a business borrows $10,000 from the bank, collects $10,000 from a debtor and makes a cash sale for $10,000. These aren't all examples of revenue. They are actually representing $10,000 of money coming into the business, but they're not all going to be revenue. So let's have a look why. Let's take the first example. You borrow $10,000 from the bank. You've got $10,000 cash. However, we can't call that revenue. Owner's equity isn't going to go up $10,000. That's actually incorrect. What will happen instead is that'll actually create an obligation to the bank called a liability for $10,000. So looking at the overall effect here, I've got cash going up 10, or assets going up 10, liabilities going up 10, so the net effect on owner's equity is 0. Our definition of a revenue was three parts. There had to be an inflow of economic benefits. That's true in this case. I've got money. There needs to be an increase in assets or a decrease in liabilities. There actually is an increase in assets. We only need one of the two. However, it's the third part that's not correct. Owner's equity hasn't gone up. So therefore, borrowing money from a bank is not a revenue. A second example was I collect $10,000 from a debtor. Again, cash has gone up $10,000. However, this won't be considered revenue. Again, that is incorrect. What will happen in this case is that one asset goes up called cash for $10,000, but another asset called debtors goes down for $10,000. So the net effect there is 0. Assets haven't gone up or down. Therefore, if assets haven't gone up or down, well, neither has owner's equity. Our accounting equation still balances with zeros for all three elements. Looking at our definition of a revenue, why is this not revenue? Is there an inflow of economic benefits? There is. We have received cash. Is there an overall increase in assets? No, there's not. While one asset did go up, the net effect on assets is actually 0, so that is not true. And lastly, owner's equity did not increase, so therefore that cannot be classified as revenue. The last example was a cash sale of $10,000, so as with the other two examples, cash has gone up $10,000. However, in this instance, no other assets going up or down, no other liabilities going up or down. That's actually pure revenue. So in that case, it actually does hold true because it meets all three criteria. The inflow of cash, assets going up overall, and owner's equity increasing overall as well. One exception to this rule is actually giving the business your own money as a capital contribution, which you're entitled to do as the owner. However, it does meet the definition of a revenue in one sense. There is an inflow called money. Cash has gone up, which will increase assets. Giving business capital will increase owner's equity, so owner's equity has increased as well. And therefore, looking at the definition of a revenue, it actually has been met. There is an inflow, assets have gone up, owner's equity have gone up, but this is not going to be classified as revenue. While assets and owner's equity have increased, the firm has not sacrificed anything to earn the money, and the owner has simply just given the business money. So therefore, capital contributions will not be classified as revenue.